With us for more is Jingyi, Economics Associate Director of S&P Global Market Intelligence. It's good seeing you again, Jingyi. Could have been better times, but here we are.
Well, good morning, Kate. Thanks for having me.
Well,
Certainly, as you mentioned.
Yeah, an added risk to the output gap that we didn't quite have in the past month. Let's tackle the geopolitical risk first, with the U.S. and Israel strikes on Iran over the weekend. In what way do you see this impacting supply chains and sentiment in the way it impacts the Philippines?
Well, thanks for the question, Kari. So certainly, I think in terms of what we have seen over the weekend, there are some, expectations that something like this could happen. The fact that I think it did actually, unfold in the way it is, I think mainly what we have been seeing from S&P Global Market Intelligence is the risk, of course, first and foremost, I think as you discussed with Mr. Eric earlier, the impact on oil prices. Those are expected to be uplifted, and certainly that translation to inflation, I think, for the Philippines manufacturing sector, I think is going to be something to watch if it does extend for an extended period of time. On the other hand, I think in terms of output, that I think it's going to be addressed, particularly from a trade perspective, because supply chain is something that, it deserves its own chat by itself. But for right now, I think that's something that we're looking quite closely to as to what the impact will actually be for, not just Philippines, but in broader Asian market altogether. And certainly, I think, from the export expectations to a large extent, we've actually recently just upgraded our forecast as well for the Philippines economy to expectation of 5.7% growth in 2026, and as well with the industrial production numbers, although that itself is formulated on the basis that we're seeing export remain rather resilient in this environment. So that's something that I think we have to keep a bit of watch of.
Jingyi, all those came before the U.S.-Iran tensions escalated, even including this latest survey, pretty good number. But those higher energy and freight costs, when do they become visible? If February isn't a good point of reference, is that shock more likely to feed through in, say, March or in the coming months?
Well, certainly, Kari. So with the manufacturing PMI, we do measure the change compared to the previous month. And I think you've discussed this just in the previous interview as well. It really does depend on whether there is this more of a knee-jerk reaction and how some of the oil suppliers themselves are managing the risk altogether with their current supply, as well as how they are hedging the risk itself, and how is that translated to the companies. I think there are some nascent evidence already in February, perhaps not really coming through very prominently for the Philippines, but we do see in other regions there are mentions of higher energy, electricity prices being a factor for higher inflation, certainly with the February manufacturing PMI for the Philippines. In fact, the price indicators have actually shown below 50, so just very slight decline. But I think that could actually very well change if we do see the spike coming through and being reflected in March. But if it doesn't turn out to be a prolonged situation, I think that's still going to help keep inflation a bit more moderated. One thing to highlight is that for the Philippines, we are seeing inflation even before this itself expected to tick higher to 2.7% from 1.7 in the previous year. And this is on the expectation of the base effect, but also we have been expecting that energy prices to be more moderated to keep to that 2.7%
as a final point, the February numbers would show the impact of the fresh global tariffs from President Trump, even well before the escalation in the Middle East. How did that show up in terms of pricing pressures, export orders, maybe even business and consumer confidence?
Well, we don't see that coming through so strongly. As mentioned, the input costs and output price indicators have been below 50, so they are showing a little bit more of this subdued situation. I do see this as a bit of a reflection of the manufacturers themselves also keeping prices rather suppressed in February, just to support the export growth situation as we see, or not just export, I should say, new order situation that we have been positive since January. New orders in February risen at the highest pace in, well, over 8 years. So that is the impact. I mean, I would say that so far in February, we haven't been seeing so much of an impact, although confidence, despite recovering from January, is still pretty subdued, Kadi.
Okay, a lot more to watch out for. Thank you so much for the context there and the insights. Jingyi Pan of S&P Global Market Intelligence in Singapore.